Trump's tariff pledges weigh on car stocks. Welcome to Market Insight. I'm Ramzan Karmali. President-elect Donald Trump is planning to impose big tariffs on the United States' three largest trading partners. He said that he would implement a 25% tariff on imports from Canada and Mexico and an additional 10% tariff above any additional tariffs on imports from China. But the shares of both US and European car makers fell in response as the news fueled fears over a potential global trade war. But are investors right to be worried? Well, to help answer that and more, I'm joined by Paul Flood, Head of Mixed Assets Investment at Newton Investment Management. Paul, thanks so much for joining us. Well, are you surprised by today's market reaction to Trump's tariff pledges? I mean, after all, one of his election campaign slogans was America First.
Yeah, I think it's pretty clear the market was aware that the tariff was a risk. But I think as you see travel and arrival, we're now at the point where some of these policies are starting to come through and are a bit of a concern to those investors who perhaps were more of the optimistic view that it was all pre-election talk.
And so do you think a full-scale trade war could develop?
Well, I think you go back to that position of where do you start a negotiation from? And so I'm a little bit more positive on the view that we are starting a negotiation tactic here. And hopefully longer term, we'll see that pale through as we move into next year when Trump becomes president and we get more detail around that negotiation. And perhaps it won't be as bad as what the headlines news has been talking about.
And why in particular do you think it was car stocks today that seemed to have been hurt the most?
Well, I think there was more of a concern around the car stocks, clearly because of this already weakening economic backdrop data, particularly in Europe, where perhaps we are more exposed to Chinese car manufacturers coming into the European market. And so that's kind of a double whammy if we're also seeing those trade negotiations a little bit more negatively in Europe with the United States.
Paul, let's turn to the UK now, and we had a couple of more firms put numbers on the extra cost they'll face next year because of the UK budget. Halfords and AO World both warned that higher employer social security contributions will hurt their bottom lines by millions. So could the changes that have been proposed last month materially impact investment and then growth?
Yeah, I think that may well be the case. I mean, ultimately, we were told that they were going to not increase any of the main tax categories. And by increasing national insurance, both in terms of the number, but also the point at which employers have to start paying it, was a material change. And that's clearly a hit to the margins of corporations in the United Kingdom, and perhaps a little bit less investor friendly in terms of enticing international capital into the UK market and investing into the UK. Alongside that, we've seen the CBI, so the Confederation of British Industries, indicate that 50% of their members are likely to reduce or lay off staff, and nearly 2/3 say they're going to pull back on hiring of staff. And so that last 1/3 has to do quite a lot of heavy lifting if we're going to see continued UK employment growth. And the risk is of clearly we see unemployment start to rise, and that starts to undermine consumer sentiment. And so businesses will be worried about the secondary effects of that.
Now, looking ahead later this week, we get European inflation data. Do you suspect we'll get a clearer view on what the ECB plans to do when it comes to the easing path?
Yeah, well, I think we'll certainly have clearer indications. The economic data has not been great. The PMIs out last week weren't that strong, now below 50. And so that's a clear indication that the economy in Europe is getting weaker. And therefore, we would expect those rate cuts. The market is pricing in about 50 basis points of rate cuts in the coming two sessions. Perhaps 75 basis points will be on the card. So we'll need to wait to see what that inflation data does. But certainly service sector we would expect to remain quite resilient there. But overall, a weaker number is what we're expecting.
And finally, Paul, how damaging is the political uncertainty in both Germany and France at the moment for policymakers?
Well, I think in France in particular, there's a bit more of a risk there. But I do think that as we go through the next 12 months, we'll get more certainty. We are seeing more of an interest in the UK just because of the stability that the government is providing over the next 4 years, irrespective of some of the changes to the national insurance that you've mentioned. Germany is a slightly better backdrop, really, from a political standpoint. We think there'll be more alignment there to ensure a reasonable government goes forward.
Paul Flood from Newton Investment Management, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.